Hello everyone, my name is Gan Leong from KAF Investment Funds. I think I've been with the firm about 12 years, and I think this is my third time here presenting to you my outlook on Malaysian equities. So today I will share with you, give you a brief overview of what I saw in the market last year and what is our firm's strategy in navigating the volatility that we do expect in the coming year. If you look at our title today, Speeding Through Chaos, chaos is what we expect, and I think at the start of the year, we already saw the KLCI index being down about 4.6% this year, being one of the markets that was underperforming most of our regional peers. Now let's start our presentation today. If you look at the performance of various asset classes since 2020, you can see that the ASEAN markets, despite the strong performance in Malaysian markets last year, the ASEAN markets actually is still trading below its pre-COVID prices. Actually, if you really look at it, it's about 15% below its pre-COVID prices. Whereas the markets that actually did extremely well is the MSCI World Index. And the reason for the MSCI World Index trading at such levels is simply because 70% of the components in the MSCI World Index are US equities. And as you can see, US equities have outperformed most equities around the world. Now, if you look at the chart above, actually most equities, most markets did really well in the first half of last year. And then the August sell-off came. Remember the yen carry trade reversal, the unwinding of the yen carry trade? Markets crashed. And only the US markets actually recovered from that crash, whereas the rest of the market, it was pretty much lackluster since that crash, because a lot of investors actually went risk off since then. Now, in this table, you can see that the Malaysian market actually did relatively well when compared to our ASEAN neighbors, other than Singapore. Malaysian market actually returned 12.9%, one of the best years that we have seen in quite a while. Whereas the Thailand and Indonesian market actually suffered slight losses, whereas the Philippines market only managed to garner a small gain. But the US market, again, one of the best performing markets last year, up about 23%. However, if you look at the US market's return last year, that 23% from the S&P 500, 22% of those returns from the 23% is contributed by NVIDIA's contribution. Whereas the Magnificent Seven actually contribute more than half of the 23% return in the S&P 500, and there's 500 stocks there. So 7 stocks actually contribute more than half the returns in the S&P 500. So it was a very narrow group of stocks that actually pushed the US markets higher. Now, if you look at these both charts here, so at the start of the year, all equities did well in Malaysia. Small cap, large cap, mid caps, everyone did well. However, in August, when the sell-off, the Black Monday sell-off, what we saw is small caps got tanked to up to only, they gave up most of their gains. At one point, they were up 21, 22%. However, after that sell-off, they were only up about 4-5% throughout the remainder of the year. It was only during the last 2 weeks of the year, in December, the markets actually start to pick up in Malaysia, whereas the small caps market actually closed the year up about 9%. Nevertheless, the best performing part of the Malaysian equities last year is your mid caps last year. And what drove the mid caps performance? Your likes of Gamuda, your Sunway, and I'll show in a table later what happened and what conspired this strong performance of the mid caps last year. Whereas your CI did relatively well, after the sell-off, a lot of investors actually went risk off. So they sold more and more small caps, so that's why small caps couldn't perform after the August sell-off, where money went to financial stocks because those are seen more defensive. Whereas your construction stocks and property stocks continue their strong momentum throughout the year. By more DC plays, there were a lot of new contracts being announced, land acquisition, so that pushed these 3 sectors higher. But if you look at from an earnings perspective, after the sell-off, actually the earnings are still intact. There's not much earnings revision, whereby companies are still reporting strong numbers. So it's more of a risk-off, a sentiment thing, where valuation got derated lower. Now, if you look at the returns of all these sectors here, last year, the 4 best performing sector, the construction sector, the utility sector, the property sector, and the healthcare sector. The worst performing sector, the telcos and energy sector. Now, our performance got dragged by our high exposure to the energy sector. If you came to the Outlook webinars that I've been giving, and also the presentations that I'm giving at the start of last year, you'll know that I actually is quite heavily exposed to energy stocks. We are quite heavily invested into energy stocks. So that actually dragged our performance last year. But construction stock, we do have quite a fair bit at the start of the year, but throughout the year, we actually trim our position. Quite a fair bit of our funds have the likes of Gamuda, Sunway Construction. However, as the stocks keep going up through the year, we actually trim our position simply because we thought valuations are looking a bit rich, expectations are look high, and it starts to look a bit like a crowded trade. Simply put it, one of the reasoning, what drove us trimming our position is when we look at other funds, fund fact sheet, more often than not, you will see Gamuda in nearly every fund house top 5 holdings. So then we start to think where the incremental buying will come. But nevertheless, Gamuda is a good company, potentially could be a great company, but at this juncture, at that particular point of time, where as it keeps going up, we thought that it's prudent for us to start to trim our position. So I think throughout the year, we are either towards the 4th quarter of the year, we are either market weight or slightly underweight. Hence why, if you look at our fund's performance in 4Q last year, it's underperforming slightly when compared to our peers. Now, another area that we actually do not have any exposure or very little exposure is the property sector, which did really well last year. The reason why we have very little exposure to this sector is simply because we think that the valuation is just too rich for our liking. Earnings delivery is just not that great relative to how much the stock prices have gone up. So valuation have re-rated to a very high level simply because, there were a lot of news where, if you look throughout last year, you saw a lot of property companies selling land at very high prices to data centers. So I think at that juncture, property in Malaysia is seen as part of the data center trend. So property stocks in Malaysia did extremely well last year, but we think that the valuation is just a bit rich for our liking. And healthcare is another area that we have at the start of the year. It did well for us. We have the likes of KPJ, but we actually disposed and trimmed most of our healthcare positions during the time when the insurance company received a lot of backlash with their premium hikes. So, that when the insurance companies started to let unit holders or people who have been buying their insurance policies, informing them that they're going to hike the premiums, it received a lot of backlash and it went viral. So the government came out and talked about it, and then insurance company was explaining that because healthcare costs have been going up significantly, so they have no choice but to hike the insurance premiums. So it seems like this sector right now will receive a lot of scrutiny. And time again, there are a lot of cases where I think if you guys are medical insurance holders, there are a lot of times where if you pay out of pocket compared to if you were to claim insurance, chances are when you were to claim insurance, the bill tends to look a lot higher than if you pay out of pocket. So we do not know how this thing will progress, but I think that, valuations have gone up to high 20s, EV/EBITDA also at its above 1 standard deviation. So we thought that, it's wise for us to cut our position and take profit on these positions. So that's why we actually sold most of our healthcare positions when the news came out. So Malaysian market did really well last year. Your CIs were up 12.9%. I think your FBM Emas is up close to 16%. So it's Malaysia expensive. Usually people say market's gone up, it's not wise for you to chase, you should take profit. Now, from a valuation perspective, we do not think markets are expensive. If you look at the valuation, PE multiples that we're looking at today. We're looking at forward PE multiples about 14.5 times. Now, historical average is about 15.5 times. When Malaysia, at one point, before the 1MDB case, when Malaysia was a darling market, seen as a defensive market where foreigners really liked us back then, we do trade at high 17, 18 times PE. Now, let's say from 14.5 times, we go back to 15.5 times, right? And then coupled with potential earnings growth. Historically, equities in Malaysia should grow 5 to 6% a year, simply because your real GDP growth is about 4 to 5%, your inflation rate is about 2 to 3%. Now, if we take the lower end spectrum of things, we can assume that the rule of thumb that earnings per share in Malaysia should grow 6%. But it's never really the case, because there will be some companies that grow faster than others. There will be some companies that are in the wrong end of the cycles where earnings would decline. So that's where active fund managers like us come into play, picking sectors that we think that will deliver strong earnings growth and will deliver potential upside for investors. Now, for us, we think Malaysia is not cheap. It's still trading at its below its historical average. The prospects looks great. We still think that, earnings growth is intact this year. Now, this is one trend that we have observed. What happened last year? Okay, so last year mid-caps did really well. Your likes of Sunway, 99 Speedmart, Gamuda, and the strategy of a lot of investors and fund managers in Malaysia, as I can observe, is a lot of times when a mid-cap stock is very close to achieving CI status, KLCI status, close to entering the KLCI, there will be a lot of buying in anticipation that they will be included into the KLCI. And once it's included in the KLCI, most fund managers anticipate a lot of passive funds coming in, a lot of fund houses who did not have the stock will have to buy the stocks to benchmark to their respective benchmarks. That's why if you look at it, you see, if you look at performance-wise historically, time and time again, stocks that go into the KLCI, the 1 year performance before they enter and 1 year after tend to be quite different. Now, of course, the likes of YTL Power, YTL Corp, even after the inclusion to the KLCI index, they still did relatively well. However, if you look at the likes of Mr. DIY, Inari, QL, relative to the time 1 year before they enter the KLCI, the returns, and 1 year after they enter into CI returns, can be quite big, the difference. And it's not really on a positive end as well. Now, what is the reason for the disparity or divergence between these two components here that we see? The reason is this. Why did the YTL group of companies went to CI? The earnings were strong. Of course, multiples did re-rate. But nevertheless, they are still trading at very reasonable valuations. We're looking at low teens valuations. Whereas your likes of Mr. DIY, Inari, QL, they entered to the KLCI not because the earnings grow 2 to 3 times. They entered the KLCI because the multiples re-rated higher. Now, let's look at what's going on today. Now, 99 Speedmart is about 19 billion market cap today. I think that, different analysts have different projections, but we're looking at 500-600 million profits this year. So we're looking at close to 30 to 35 times PE. Now, problem here is when a stock enters KLCI, not because earnings grow 30-40%, but multiples re-rated higher, then the probability of them disappointing is actually relatively high. Because when your multiples are at 30-35 times, unless you, to maintain those sort of performance, whereas 99 Speedmart went up 45%, unless you think that the multiples should trade at 50 times, which highly unlikely but not impossible, then earnings will need to grow at a very high magnitude to maintain the sort of performance we saw last year. That's why we do believe that year in and year out, every year there will be a new winner. In 2023, we have the likes of YTL Power, YTL Group. Last year, we have the likes of Sunway, Gamuda. Usually, more often than not, it's highly unlikely they will be able to maintain those sort of returns that we experienced 1 year ago. So our job is to always to look for what we think this year the opportunity will be at. Now, if you look at those that got excluded, same thing as well. More often than not, after the exclusion, they actually do better. So it seems like there's a lot of anticipation here that these companies will be excluded from the KLCI index, so why not let's sell it now? Okay, so foreign shareholding. Foreign shareholding is still at very low levels right now. It's at 19.7% compared to April 2007's high of 27.5%. So there's still a lot of room. It's not like the foreigners crowded our market this year. Foreigners didn't. Foreigners actually had a net outflow of more than 5 billion this year. So, if you look at the historical trend, there is still room for foreigners to come in. And why is it important? Here. So look at the the four sectors that did really well last year. Property, construction, healthcare, and utilities. And which are the four sectors we saw foreign inflows? Property, construction, healthcare, utilities. Why? Generally, when you look at inflow, outflows, whether it's institutional buying or foreign buying, one buy, one sell, it should net it off, right? It's more of the pattern of buying. Foreigners tend to buy at a more aggressive manner. So the stocks tend to go up more faster because they're willing to chase the stock up. Whereas institutionals in Malaysia, your likes of your GLICs, your EPF, they tend to buy things in a more measured manner. Hence, they are unlikely to keep pushing the price higher. So that's why when a stock is liked by a foreigner, you tend to see a very strong momentum. Furthermore, last year, it was the institutionals that actually support the market, not the foreigners. Foreigners have a net outflow of 5 billion, retailer about 4 billion. It explains a lot why small caps didn't do well, because usually in the retail space, the small cap space is mostly retail buying, and retailers last year actually took money off the table. Now, so under Trump's administration, what will happen? We all know that Trump is entering office soon, and there will be a lot of volatility. So we look at the Trump's policy proposals. Number one, slash corporate tax rate. Clearly, he's pro-business. This will be great for US businesses. Hence why we also think that US markets were likely to continue to do well, simply because if you cut the tax rates, your EPS will just grow. Because, your EPS per share is after tax, right? So now you pay less taxes, your earnings will just grow by that much. Number two, tariffs. This will happen, we think. And what we understand right now, Trump's administration is exploring, not increasing tariff at one go, but in a more measured manner, 2 to 3% a month. So they are so worried that inflation gets out of hand. So we think that being pro-business, they will try to get as much feedback from US corporates as possible. So we do not think that, Trump will do very drastic manner and let the market crash. I do believe that the Republicans and Donald Trump are very market friendly. So hence, in the event when there's a strong correction, there will be opportunities to buy sectors that you like, because we do believe that they will introduce measures to revive the market. Hence why, for us, we think that next year will be a very volatile market. This year will be a very volatile market, and there will be opportunities for us to pick up stuff that we like at cheaper valuations. Now, the third one, stop Chinese from buying US property. Now, I think more importantly, we jump to the third last one. Repeal Biden's executive order that imposes safety and technical requirements on AI products. Now, this is a key talk right now, right? Because recently, they just introduced a new act that's trying to restrict the exports of advanced GPU chips to countries that are not their partners. They are trying to suppress China's artificial intelligence growth. And because of this, Malaysian market actually suffered badly this year. This year, the construction sector is down 10%, and I think everyone wants to know, what's our view on this data center place, right, after this. Yesterday, JP Morgan actually downgraded Gamuda, and I think that, there's, of course, if this act do come true, this policy do come into effect, there will be a lot of downgrades on data center plays in Malaysia because, again, like I say, a lot of expectations have been priced in. So people, already account for all this earnings growth from these data centers in their forecasts. And this will have to reverse if the policy were to come into play. But nevertheless, we think that the sell-off is rather steep. Hence why we think there is opportunity in data centers plays this year, or at least at this juncture. Now, for us, we think the sell-off is a bit steep. Actually, it's very steep. Let's not forget, we still think, even though last year we trimmed Gamuda on the way up, we still think it's a very good company. It's run by a top-tier management. It's, Justin is only, the Gamuda engineering CEO is in his 30s, very ambitious, and he has proven that he can win a lot of contracts. Now it's more of a question of whether they can execute on these contracts without problems. And if they can, Gamuda will likely be not just a good company and potentially be a great company because the team is actually very young. So they have a long runway to grow. And they are doing the right things. But again, for us as investors, we don't just buy stocks just because, it's a good company. We have to evaluate what kind of valuations we are paying for these stocks. If it's a good company but we pay 100 times PE, is that a wise investment decision? That's why time and time again, you do see, Warren Buffett sell certain companies, buy certain companies, when he thinks there's better opportunities elsewhere. But at this juncture, after the sell-off, we do see pockets of opportunities in the data center place, from large cap to small caps. And we have been building up again our position in stocks that we have sold last year. Now, like for this data center that we're talking, that this new potential policy to be put in place, how will it impact Malaysia? Now, we did our channel checks with those data center players, the smaller ones, especially those installation guys, the M&E guys. To our understanding, the Chinese data centers in Johor, which is one of the areas that people are very worried that will be impacted, most of their first few phases of their data centers actually do not use advanced GPU chips. They actually use CPU chips, which will not be impacted from this new policy. So we think that the Chinese data centers in Johor will continue because these are not your large language models, training where AI data centers, those hyperscalers are using. Whereas you look at Gamuda's case, recently they acquire a large plot of land in Negeri Sembilan, Port Dickson, to build a data center campus. They will be building a water treatment plant for one client. The data center campus, the whole land is actually dedicated to one US client. And they also won't be impacted in like these projects, simply because if you look at the policy that's being introduced, it will exempt the few large tech players. And if you can verify the end user is a US company, you will be exempted. So we think that quite a fair bit, like those who caters to the likes of Amazon, Meta, Google, they will not be impacted. And the reason why a lot of people build data centers in Malaysia is simply because our energy is just cheaper than a lot of people. We have infrastructure in place, we have excess energy and very attractive energy pricing. Our land is relatively cheap, actually very cheap compared to Singapore. That's why it becomes a very attractive destination for people to build data centers. The Johor data centers are different from data centers elsewhere. Those that are used to train AI models, those hyperscalers, don't need to be in Johor because they don't need to be close to those fiber optic cables. They can be, that's why this US customer will be in Negeri Sembilan. So they can go around different parts of Malaysia to build the data centers. The ones in Johor is because you need to reduce the latency. So those are data centers that they rent to different people, like the likes of YouTube, TikTok, your GDS data centers now renamed to Day One. They cater to different clients. So they need to reduce the latency. That's why they need to be near the optic cables. Hence, why they need to be in Johor, because those cables are near there. So I think there's two different spectrum here that we have to look at. So I think the market's overreacting. Hence why we are actually building our position on these stocks. We think that there's opportunity. But nevertheless, if it were to come true, and if they were to enforce it difficult, we will have to reevaluate our position if there's any strong rebound. So I'm not going to discount the fact that we may take some profit if the thing goes up again. So it's going to be a volatile year. It's very difficult for me to come out and tell you now that, throughout the year, don't worry, you buy this sector, for the next 12 months, you close eye, no problem. I don't think that will be the case this year. As for energy stocks, which is, I think I ran out of time, maybe I just give a brief update on our position on energy exposure. Because I think if you look at last year when I did this presentation, I actually tell people I like energy stocks. I still like energy stocks. It's still one of our highest exposed sector. And I still think that despite the sector didn't do well last year, the earnings delivered. Today, a lot of oil and gas companies in Malaysia are trading at less than 10 times PE. We're looking at 7 to 8 times PE, a lot of them, giving 3-4% dividend yield. And we do expect that their margins will surprise this year, will be above consensus expectations. The reason so is because Petronas last year awarded a new batch of contracts, and those contracts are likely to command higher margins than the old contracts. Hence why we think that oil and gas stocks, it's an attractive investment proposition for us at this juncture. And if you really look at it, Warren Buffett sold Apple and bought Occidental, right? So I do not believe that, even though the sector may not be favored, but at the right price, it can present a good investment opportunity. I think I would like to conclude my presentation today. Thank you very much for attending my presentation. Hope that I can see you next year.